Good morning, everyone. Robert Reaburn here from Life Pro Asset Management. I hope that everyone's having a great week so far. And as usual, if anyone has any questions or concerns, please feel free to dial us at 888-543-3776. If you need to reach me directly, you can on my mobile phone at 858-354-5114. But the message this week is really going to be about looking past the virus. Whether it's coronavirus or the election, there's certainly not a lot of headlines out there that can distract us from doing what we need to do as long-term investors to stay focused on fantastic companies that are in the process of going from good to great. And that's really what we're here for. We're here not just to identify these companies, but to instill some level of discipline both here at the corporate level and also within each of our individual clients and advisors. Because we know that if we can do a good job being disciplined, we can do a good job staying focused on the individual companies and their future prospects and their future earnings power, we're going to do a pretty good job of being able to create value for everyone. So that's really what the message and focus is going to be about today. So overall, we want to stay focused on what matters. Right now, this is the same headline from last week, and we did it for a reason because it's important to remain consistent. Money is cheap, buy stocks. Because if we look at the bond market's incredibly expensive right now. But here's what we're going to go over today. Quite simply, we're going to look at liquidity, interest rates, and overall investor sentiment. Those are the three core pillars of really what influence asset prices over the short and long term. Also, we want to take a look at a few charts and be able to really understand what does a current recovery look like. Does it look like is it a V-shaped recovery? Or is it a U-shaped recovery, a W-shaped? We've heard all of these shapes being sort of tossed out and bandied about in the media. What's the actual recovery look like right now? So we're going to show a few charts here that actually put some pictures behind the verbiage that we hear in the media. And then, of course, we want to make sure we're staying focused on stock picking. Stock picking is extremely critical right now. We're going to reinforce that with a few charts. But despite what everyone thinks in terms of the Federal Reserve pumping liquidity and goosing the stock market, as we hear so often in the media, the stock market is doing its job. It's separating winners and losers. And the question is, which side of the aisle are you on within the market? And we want to do the best job that we can to make sure our clients are staying focused on areas of long-term secular growth and avoiding those areas of long-term decline. That's what generates outperformance over the long run. Real quick, in terms of a performance update here, we can see here we're back to all-time highs, or just a shade under. 2020, so far we are up 49.64%. That's a nice 5% jump from last week. Overall, we're able to outperform the market in 2020 by close to 49% after fees. Since inception, January 1st, 2017, we are up 143.85% after fees. That gives us an outperformance after fees close to 98.6%. So we're happy with that performance. And one of the things that we talked about last week was that the pullback we saw on Monday of last week was extremely healthy. And now we're seeing the results of that. We saw a lot of the stocks that we own pull back, deflate a little bit, and now are re-accelerating to the upside. So if you've been entertaining the option of perhaps investing in the opportunity strategy, now is the time based on our research. We definitely like the way the portfolio is set up here, at least over the next few weeks. And we're going to continue to monitor any potential shifts in the market away from sort of what we call long-term secular growth and into some of the areas of the market that have been trailing. But we just don't see that right now. But we're going to continue to monitor that going forward. But certainly love the prospects here over the next few weeks. In terms of breadth, we're seeing not only has the market continued to rally, not only have the healthy areas of the market led led the charts, but more and more stocks are participating in this rally. The chart we see here are the advancers versus the decliners. You want to see this chart confirm the rally. If we start to go up and this chart is going down, that's telling us that fewer and fewer stocks are supporting the stock market. In other words, we're getting a narrowing of breadth. That's a contrarian indicator when markets are hitting highs. But when this is hitting highs with the market, that's a very healthy future signal for the overall market. The other thing is, let's keep things simple. The three horsemen are on our side. First, inflation is low. That means interest rates are not going up anytime soon. Second, the supply of cheap money continues to go parabolic, as we can see in that chart. So low inflation, low interest rates, a huge supply and growing supply of cheap money, and it's underpinned by the fact that investor sentiment remains very low. So in other words, we're not seeing this irrational exuberance in the stock market that can offset these other two positive factors. So when all of these factors are on our side, we don't want to make this more complicated than it needs to be. These are very positive attributes for the stock market. Secondly, we talked about what does a V-shape look like? Or sort of what does the recovery look like? I might have just given away the answer. But what we can see here is when we look at retail sales, that's over 73% of U.S. economic GDP or U.S. GDP. When we look at motor vehicle sales, a picture says 1,000 words. And if that doesn't look like a V-shaped recovery, then I don't know what does. What really makes us positive is not only is this clearly a V-shaped recovery, but the media is super negative, right? We know that COVID cases are spiking throughout the South. This is something we've taken extremely seriously, but the U.S. economy is resilient. So that is something that we need to take note of, is that in March, there was a shock event. The economy was not anticipating the outbreak of a pandemic. Now, everyone has sort of shifted their business models, has stayed focused on the fact that coronavirus is there and is much more resilient as a result. So this is typical throughout different types of crisis, whether it's recessions, financial crisis, war. The first impact is always the worst, and then the second, third waves tend to be less impactful because people make adjustments. That's the miracle of capitalism, is that business models become more resilient as the crisis wears on. And so we can see that here in the overall picture of the recovery so far. And the other thing, of course, is that stock picking really does matter. Don't let people tell you that, oh, the Federal Reserve is pumping money into the system and all stocks are going up. That's simply not the case. If you have owned airlines, if you've owned cruise liners, if you've owned the banks, if you've owned industrial companies, you know that you're struggling this year. You're down quite a bit. In fact, the airline ETF, which includes other aerospace companies as well, the manufacturers of airplanes, etc., it's down 48% off its peak. Meanwhile, the software ETF is near all-time highs. Now, that's not to say that this is that past performance is, of course, indicative of future performance. This is merely an illustration that stock picking does matter. If you are able to successfully navigate money away from the areas that were at the center of the COVID storm and toward areas of long-term secular growth that actually can do well regardless if COVID is here or not here, recession or expansion, you made money this year. And that's what we're trying to do on a daily basis. Eventually, there is going to be a shift the other way. That's not here yet. We don't see that even remotely close, but at some point it will happen. And that's the importance of having a tactical strategy in your portfolio. And that's what we try to do on a daily basis. The other big event that's happened here in the last couple of days is that volatility, the VIX index as it's so called, has broken key support. In other words, that demand for portfolio protection that protects portfolios when markets go down has broken very, very key support. When we spiked up during the big crisis in late February and early March, the VIX has remained above 28 ever since. And really 28 was sort of a key level. And now that we've broken underneath that, that may very well, from a trading perspective here over the short term, open up the markets to a new, fresh breakout with new steam and new energy to continue the market, to allow the market to continue pushing higher. So the fact that it broke key support, and we saw the reflection of that in our performance yesterday, where we were up close to 5%, I think is very indicative that we're starting to see a fresh head of steam coming back into the market here. So this is a very positive development. And then lastly, credit risk just continues to decline. We show this chart every week. It's important to stay focused on this chart. But again, the level of credit risk in the system is continuing to decline. So when you see credit risk declining, when you see liquidity on the rise, when you see investor sentiment is poor and interest rates are low, inflation's low, all of these things coming together, it's just hard to see where there's a big panic in the market around the corner. And so until these factors start to flatten out or go the other way, we're going to keep our portfolios positioned the way they are. So overall, money's cheap, inflation's low, sentiment's poor. This is a positive thing for stocks. Don't make it more complicated than it needs to be. We see that reflected in the data. When you actually look at the charts, I encourage people, look at charts, get rid of words, just look at charts when it comes to economic data, and picture will give you tell you 1,000 words. It looks very V-shaped. And then demand for protection is falling apart. We saw that in the VIX, and the credit markets continue to heal. So overall, things look great. If things were to start to change, rest assured, we will not hesitate to rejig the portfolio a little bit and increasingly raise cash, but we just don't see that right now. We have to pay attention to what the charts, the data is telling us. And right now, all things look pretty good from a portfolio management perspective. So if anyone has any questions or concerns, please feel free to reach out, 858-354-5114. Thank you for your business. We are so appreciative for all of the support that our advisors and their clients give us. None of this success would be possible without you. And certainly, if you have any questions, don't hesitate. Our offices are open, and have a fantastic week.